Hey, it's Kevin the Credit Crusher here with another credit tip. And today we are talking about business lending. Going to get into a full conversation about what to do if you can't get access to traditional business lending. But before we get into that conversation, make sure you like, follow, share, and subscribe on all of our social media platforms. And if you're watching this on YouTube, which is youtube.com/Premisien Credit Counseling, make sure you, again, like, follow, share, and subscribe, and hit that notification button. Let us know who you are, and make sure you get access to all of our videos when we put up some new content. All right, so business lending. A lot of you guys may have had trouble getting lending from traditional banks, partly because traditional banks have real stringent guidelines on who they lend to in the business arena and personal, but business specifically. And you're going to want to make sure that you have some things in place. If you don't have those things in place, it could be difficult to get traditional lending. But don't fret if you cannot get a traditional loan from a bank. There are several other options that you can employ to get funding for your business, and I'm going to go through a few of them right now. So one of them, and probably the most accessible, is the SBA loan. So SBA is Small Business Administration. They don't actually lend money. They work with partners that do lend money, and those partners understand that the businesses that are coming to them for funding may have difficulty being bankable in other financial institutions. So they are a little bit more lenient on their guidelines. So you can go to SBA.gov. You can see a list of their lenders. Apply through the SBA.gov website, and you'll see if you get approved, and then you'll connect with those lenders. All right, SBA.gov. Another lending instrument is a credit line. And a credit line is a little different from a loan in that the credit line will give you up to an amount of money that you ask for, and then you can use a portion of that when you want. You pay that portion back, and when you pay that portion back, then you'll have access to more of that lending. For example, you get a credit line of $25,000. You might use $5,000 of it. You pay the $5,000 back. Now you get another line for $10,000. You pay the $10,000 back. You get another $15,000 later, and that's how you use it. And you use it as you are moving through your business. What I suggest for the first one or two credit lines that you get is actually use the credit line to pay itself back, so you can show a pattern of paying, which will help you, one, increase your credit line and get a better rate on the interest of that credit line. So an example is you get a $25,000 credit line, maybe the interest is 9%. You use $5,000 of it, put that $5,000 in a checking account, and then have the bank auto withdraw their monthly payment for that credit line out of that checking account, and just continue to do that. And then you'll show a history. You maybe do that once or twice. Once you've paid it off, then you'll show a history of great payment. Now you can go back in and renegotiate that credit line, maybe down to 6.543%. In addition, if that credit line is $25,000, you might be able to bump it up to $50,000 because they show you a great payment history of those first two $5,000 withdrawals. All right. So we talked SBA, we talked credit line. Another way to get money for your business is a merchant cash advance. So merchant cash advance usually works for companies that take credit card payments. So you will, if you process payments on a credit card, they will look at your payment processor and give you money based on how many payments or how much you process during a given period, maybe a month or a week. So you might, let's say your business processes $10,000 worth of credit card payments per week. You get a $10,000 merchant cash advance, and then every day that your money comes in, they will take a small portion of it to pay that $10,000 back. Those are for companies like mine that process credit card payments. If I needed to have some money for marketing, they would take it out of the process payments. And it's great because they take it out of every payment that you get every day. So, sometimes restaurants are a great example of where they could use that, where Today they may process 10,000. Tomorrow they may process 3,000. The next day they may process 20,000. And as it fluctuates, you are paying the money back. So that's a great way to get financing. Another financing instrument is a microloan. Microloan is typically between no more than $50,000, between $10,000 and $50,000. And these are companies that give out these small loans to businesses. Again, they don't have such stringent guidelines. They know that it's usually for working capital. So you can just Google microloans and find out where you can get one of those from. Okay. Another way to finance your business is to get equipment financing. So if you're in an industry that requires equipment, maybe major equipment, if say you're in the construction industry and you need a piece of construction equipment and that may cost you $15,000, $20,000, you can go get equipment loans. And there are companies that just do equipment financing. They don't do regular loan. They do equipment financing. And the equipment that you're about to buy is the collateral that secures the loan. So they know that if you default on that loan, that you are signing an agreement that says you're going to forfeit that piece of equipment. Now, of course, they don't want to actually take the equipment. They'd rather you pay the loan because then they have to sell the piece of equipment. But if you defaulted, that's a way for them to get their money back. Then there's invoice financing. And invoice financing is great for companies like trucking companies, let's not say trucking companies. Let's say furniture delivery companies. So there are companies that will deliver furniture from major box retailers. The major box retailer is going to pay them at the end of the month for all the furniture deliveries. They're keeping track of which ones got damaged, which ones they actually delivered. And then at the end of a week, 2 weeks, or a month, they are going to pay a lump sum. This is a way to get capital to operate while you're waiting for that invoice. So you sign the rights to that invoice over. You get $10,000, $20,000, and then when that $20,000 invoice comes in, the company, the invoice finance company is going to take all or a portion of it to pay back the money. All right. Then there is factoring. Factoring is sort of the same that I just described. A factoring company is usually trucking companies that are delivering goods over the road. Those companies are good for factoring. And the factoring is just, again, you're going to be billing the company that you're delivering for. They're going to give you a loan based on those bills. And once you get the money from those bills, they are going to take their money. All right. So let's see. We talked about credit line, SBA loan, equipment financing, invoice financing. We talked about micro loans. We talked about merchant cash advance, and we talk about micro lending. The last thing we want to talk about is real estate, or we want to talk about two last things, but real estate or commercial real estate lending, sometimes called ARV loans. ARV stands for after repair value. This is great for companies that are doing real estate investing. And it doesn't, when we say commercial, we don't absolutely mean you got to go get a warehouse or a building. You could be investing in what they call fix and flips or buying whole properties. So a fix and flip, let's say it's a residential property. You go buy the property. Let's say you buy it for $50,000. You put $50,000 worth of rehab into it. And then that property is going to sell for $200,000, which means you're going to make a $100,000 profit. Well, with an ARV loan, they are going to give you money based on that after repair value, which is $200,000. They may give you as low as 60%. They may give you as high as 90%. Typically, it's somewhere in between 70 or 80, but let's say 80. So they're going to give you the after repair value on that property is $200,000. They're going to give you 80% of that, which is $120,000. It's going to cost you $50,000 to purchase, another $50,000 to rehab. So you actually have an extra $20,000. They don't actually give you that extra $20,000. If all you need is the $100,000, that's what they're going to give you. But they would give you up to $120,000 if that's what you needed to acquire and rehab the property. So you're going to get the 100,000. They may charge you. Now, the thing about an ARV loan is the interest is going to be expensive, but you can get it nevertheless. They're going to charge you some money, so you might end up paying back $20,000 on that $100,000 loan, which means the total amount you're paying is $120,000. Your net is, of course, the $80,000 profit, and you got into that property because they gave you that loan. Another way to get into it is hard money. Hard money is very similar. It's actually exactly the same. The only difference is a hard money loan typically has a shorter payback period, shorter term. Hard money lending, I've seen the most I've ever seen is 18 months. Some may do 24 months, but they rarely ever go past 18 months. But usually it's the 6-month range. So you've got to pay back all of that money within 6 months. Now, how companies use a hard money loan is, by the way, on a hard money loan, the interest is usually really high, like 10, 12, 15%. So be careful with that. The understanding is that you're going to get the property. If it's a fix and flip property, you're going to get the property. You should be able to turn that property over in 30, 60, 90 days. And then you'll pay the money back. You'll pay them back before the actual interest hits or the interest costs you too much. If it's a buy and hold, the idea is that you're going to get it, rehab it, and then refinance it once it's rehabbed, and you'll pay the hard money loan off, and then you use the rest of the money to, or you'll use that to pay off the hard money loan, and then you'll owe traditional financing on it. So that's ARV. Most of that is secured by the property. Again, if you default on it, the understanding is that you're going to forfeit that property. So the loan company, the lender, is going to come and take that property from you. All right. So those are different lending options for you. I'm going to go through them again. You have the SBA loan. You've got the credit line. You've got equipment financing. You got invoice financing. You've got micro lending. You got merchant cash advance. You've got factoring. And you've got real estate, commercial real estate loans coming through either hard money or an ARV loan. Keep in mind that you can find lenders that specialize in each one of those things just by Googling the names that I just said. Shouldn't be an issue, but use those. And you can use a combination. So you may use a credit line and factoring at the same time. All right, so just you can put those things together, but that's how you can finance your business. One of the other ways is one of the really non-traditional ways, and one of the ways I like best is debt financing through crowdfunding. Those of you who have never heard of crowdfunding, it's just a way for you to get funding from your business from a group of people instead of one institution or one person. You put your crowdfunding ask on a crowdfunding platform, and there's debt and equity crowdfunding. Debt crowdfunding just means you're going to have to pay back something with interest. So let's say you needed $100,000. You post that need up on one of the debt financing crowdfunding platforms. You bring people to it, and people from all over the world can come in and contribute. So instead of having one person give you $100,000, you might have 10 people give you $10,000 each. You still get that $100,000. And let's say it's for that real estate property or real estate project we were talking about. So these 10 people give you the $10,000 each. They're expecting a $5,000 profit. So you're going to give each one of them $15,000, meaning your total payout is going to be $150,000. You're going to make $200,000, which means you net $50,000 in profit. Great project to invest in, and you can get that $10,000 from somebody over in Kenya. You can get some money from somebody in Canada, just as well as you can get somebody from Dallas, Texas. Right? So go on the crowdfunding campaign, and that's debt crowdfunding. Equity crowdfunding is a little different in that you're giving up ownership in your business, a small piece of ownership in your business in exchange for the money. but the crowd part of it is the same. So you can get people to contribute as little as $100 on some of these platforms. You go to an equity crowdfunding platform, you say, I need $100,000, and people can put on as little as $100, and you may have 1,000 people give you $100 each, which is $100,000, and they're going to have a micro fraction ownership in your business, maybe that $100,000 equates to 10%, and it breaks down to that $100,000 equals 10% equity stake in your business. You're going to sell shares, and those people are going to get a micro fraction ownership in your business, but they are not going to get enough ownership that they can dictate what's going to happen with the company. So debt crowdfunding, equity crowdfunding, great ways to finance your business in addition to all the other ones that we talked about. That's the way that you can get around some of the business lending stringent guidelines that exist out there. All right. Again, this is Kevin the Credit Crusher. We got a business tip. Like, follow, share, and subscribe on all of our social media platforms. You can use the name Premisien. That's Premisien. If you're on YouTube, don't forget to hit that notification bell so you can get access to all of our new and recent videos. All right, stay tuned until next time when we come with another credit tip.